Well, here we are well into the fourth quarter of 2022, and this has been the most tumultuous real estate year that I've had the pleasure of operating in my 20-year career. Now, I'll get into the crazy stats in just a moment, and if you stay till the end, I'm going to give you some really helpful tips and tricks to help you navigate this market, whether you're buying, selling, or investing. Now, there are three new pieces of legislature that are going to land in January of 2023 that are going to play out over the next year and have their effect. Now, the first of which is the elimination of foreign buyers altogether. Now, we saw the 20% foreign buyers tax back in 2018, and that cooled things off. Now we're completely eliminating their right to buy real estate. So in Kelowna and the Okanagan, that's only really about 2 to 3% of our overall sales come from international buyers. So that's not likely to have a direct effect. But the lower mainland, which does make up 20% of our sales, is going to feel that one majorly, as their market is still majorly influenced by international buyers. And so we're going to see less of those people moving here as a result of that. So I do expect that indirectly and directly, we'll see a little bit of that playing out in 2023. Now, the next piece of legislation that's coming is the new 3-day mandatory cooling off period. Now, this is the government's, a dollar short and a day late response to an overheated market where buyers were finding themselves having to forego inspections and, come in with all cash offers in order to be competitive. So now there's a 3-day cooling off period built in where for a small fee, people can collapse their offer if they want to rescind it or if they felt like they got caught up in the hype. This is likely to have no effect, as the vast majority, in fact, almost all of the offers we're negotiating now have 2 pages of conditions to protect the buyers, and many outs they don't have to pay a fee to use if they want to exit a contract. And so I really don't see this having any effect. In fact, it's probably spent millions of dollars on think tanks to come up with this, and it's going to be a complete waste of time and money. The third change is going to affect landlords and tenants eventually as well. The big change is this: a landlord no longer has the right to dictate a mutual agreement to end the tenancy at a certain date. And so who this affects are the people who have short-term rentals, people who rely on Airbnb revenue in the summer and then switch to a long-term rental in the off-season. So now those landlords will run the risk that if the tenant doesn't want to leave come May, they don't have to. So what they'll do as a consequence is probably not rent their house to that student or to that person that's moving to town while they're building a house, etc. They'll probably just keep their home listed as a short-term rental so that they can ensure that they'll have their property available when the good times come around, because you get weekly what you would get monthly during the 12 to 15 weeks of summer. And so landlords will not take that risk. And so what that will do as a consequence is shrink the supply of rentals, particularly for students who rely on those during the school year. And so we'll see actually upward pressure on rental prices because of that. Now, as we're on rentals right now, I was talking with our property managers, and we're seeing that right now there's a little bit of a glut of inventory and some softening in rental prices. It's a bit of a renter's market right now, and that's because we've got over 1,000 new purpose-built rentals that just hit the market, and we've got all of those short-term rentals that I explained back on the market as well. And so that's actually really increased the supply. But my belief is that as we get into next year, into the busy season of the spring, we'll go back to seeing some upward pressure on rental prices, because many people who would have otherwise bought will choose to rent property. And as the new inventory gets absorbed, we'll go back to a more normal vacancy rate close to 0%, and then those prices will go back up. So I do expect to see that in the new year. Now, as I'm sure you've heard, the Bank of Canada has raised interest rates yet again, another 50 basis points. Now, this is the steepest incline in interest rates, and this has precipitated the lowest mortgage demand in 25 years. What does all that mean? Well, it means decreased affordability. People's purchasing power has been cut yet again. I mentioned in the last video that in order to get a $300,000 mortgage, a person needed to have a $76,000 household income. Well, that number has just gone up to north of $80,000. So that does not compute or pencil out for the average single-family home. And that's why we're seeing the single-family home market affected the way it is. Now, with this decreased demand, we are seeing it's taking about 25% longer for homes to sell, and they're selling for less money in relation to their list price. In fact, one of the most dramatic things we see in the stats is that the average discount has increased 800%, whereas this time last year, we were seeing homes selling at about 0.5% off their list price. Now we're seeing a full 4% off. So that's an 800% swing in the average discount. Now, I've been reporting on list to sell ratio for a long time, but this time around I wanted to go one step further and actually track the recent sales and look at what their original list price is when they entered the market. Now, what I found blew me away. The average single family home that recently sold had originally listed close to $1.2 million. And what it sold for after a series of price reductions was $935,000. That is close to a 25% swing and disparity between the seller's original expectations and where the buyers are at. So what that tells me was that sellers were acting like it was 2021 and buyers were acting like it was 2008. And it took a while for a meeting of the minds to happen. And so we've actually seen the single family home market, which is the people most affected by interest rates, we've actually seen the single family homes have come down nearly 20% already and then take a further 3 to 5% off when the negotiation comes around. And so we're seeing a big gap between seller expectations and where buyers are really at when it comes to a single family home. Condos and townhomes have not seen quite as much of a hit. In fact, as people got compressed into the lower price points, we've only seen about an 8% drop in the condos and the townhome market. And so as I mentioned in the last video, one of the best things that you can do if you have the appetite and financial capability to move up is to take advantage of the fact that your place only came down 8%, but your move up property, the house that you need with the bigger square footage, has come down by 20%, and you can pick up that difference in the exchange. Watching prices over the last 12 months has been a roller coaster ride. You can see we were climbing at 3% a month, up and up and up and up until March, and then we've come down the other side of that roller coaster at the same trajectory, just going down at the same 3% a month. And so we're back to exactly where we were this time last year, which is an emotional ride for sure. But if you zoom out, you'll notice that, even since the beginning of the pandemic, we're still way up. And if you zoom out 5 years, real estate's been a wonderful hold. It's just, it had a pretty crazy last 12 months. Now, where does it go from here? Hard to say. What I do know is that if I think back to 2008 and I look at from peak to trough, it took about 11 months to hit the bottom. And so we could be 7 months of our way through a similar timeline. Now, as I mentioned, you can't paint the whole market with the same brush. Condos and townhomes are not falling the same way. Big White, for example, is not coming down. Big White has weathered the storm better than anywhere else in the central Okanagan. And so there are little sectors. And another sector that's doing well is the luxury sector. In fact, homes over $3 million, those sales are actually up 70% year over year. And we've seen that home sales in the $1 million to $2 million and $2 million to $3 million segment are up year over year. So what this tells me is that these interest rate hikes are affecting the 99% a lot more than they're affecting the 1%. So a lot of people are asking me, is this a bad market? Is this a bad time to buy? And what I share is there really is no good or bad markets. There's only good or bad tactics. And so every market, whether it's on the way up or on the way down, presents a certain amount of opportunity, and there are potential pitfalls where you can get stung. So it's important that you get really good consultative advice right now and you execute the tactics that work for this particular market. Now, I did promise that if you stuck with me till the end, I would share some tactics and some ways to win in 2023, whether you're buying, selling, or investing. Okay, if you're selling a property in today's market, there's some things that you need to know. Number one, you definitely want to sell first, buy second. And the reason for this is that doing it in the reverse order can cost you thousands. For example, if you go and negotiate right now, subject to the sale of your home selling, I can almost guarantee you're paying more than you would have had you been a cash buyer. The other challenge that leaves you with is that you're buying on the way that the market's coming down, and so you're actually paying the highest that property is going to be worth for the foreseeable future. Then you have the burden of trying to sell your home, and as time goes on, whether it takes a month or 90 days to sell that property, it's been falling along the way. It also puts you in a compromised negotiating position because you don't want to lose that other house, so you're likely to take a lower offer in that negotiation because you're in that sort of caught between a rock and a hard place situation. And so it'll cost you thousands. So the real thing is sell your home while it's worth more than it'll be worth next month. And then next month, go and buy that next property when it's worth less. And do it without the stress and with the proper negotiating position on both sides. Next, if I'm selling a property right now, I am thinking, how do I offer attractive terms to the buyer? So there's some things that you can do. Number one, be open to taking on a trade. It doesn't mean you have to stay with this property forever. Maybe you take a condo on trade for your home and then you either turn it into a rental or sell it at a small discount and get rid of it. It'll pale in comparison to the discount you probably would have had to take on your home if you were to sell it to somebody who didn't have something to trade. Next, offer vendor financing. There are many people right now who are trying to make these new bank rates work. If you can help somebody who's high ratio eliminate their CMHC fee and get a longer amortization, when you have 20% or down or more, you get the 30-year amortization, which lowers the payment. If you're willing to leave 10 or 15% of your equity in the home as a vendor take-back mortgage, you can lower that person's payment and shrink the amount of available homes that are willing to offer those terms for the buyer and garner additional attention from buyers. When I'm pricing a home right now, if I want to make sure I sell quickly, I will find the most recent sale that happened that is comparable to mine, make some adjustments, and then I will be 2% less than that sale. I'm not pricing my home based on what everybody's asking. I'm going to come in slightly less than the most recent sale that was a home just like mine. And if I don't sell in the first 2 weeks, I'm going to readjust my marketing plan and my pricing plan quickly, because I know that time is not on my side, and this is not the market where you hold out for a higher offer. Don't find yourself in a situation of you're chasing the market down. Get slightly ahead of it and grab that next buyer, because buyers are all value shopping right now. They're not looking to pay retail for homes. They're looking for the best value, and they want to buy it slightly back of that market value price. Another tip for sellers right now, if you have a mortgage that you don't intend to port to your next property and it's at a lower rate than what a buyer can get today, which is pretty well any mortgage you got from a year ago or before, offer it as an assumable mortgage. Make sure that your mortgage is in fact assumable, but most of them are with qualification, and offer that as an incentive that a buyer can assume that mortgage and then have a blended rate with the additional amount they need to borrow from the same lender. That reduces their monthly costs and makes your home stand out above others. So there you have it. Offer terms, vendor financing, assumable mortgages, and consider taking lower priced properties on trades to make your property stand out in a market where there are more properties for sale than there are buyers buying them. If you're buying a property in today's crazy market, there are a few little rules you want to follow as well. Number one, get a rate hold today. We are in a climbing interest rate environment, which means waiting to find out what your interest rate will be once you found your home could cost you another 50 or 75 basis points, as we're seeing some big jumps with the Bank of Canada. So secure your rate today. Number two, this is a move-up market. If you are currently in a condo or in a townhouse and you want to take on more real estate, this is a great time to do that. You will pick up the difference, as your properties have not been beat up as much on the pricing as some of these more expensive single-family homes. And consider trading your existing property to the homeowner that you want to buy from and getting 2 transactions done at once. This can be a great way to get top dollar for the existing property that you're in and transact your next sale simultaneously. Another great tactic that is often overlooked for buyers is negotiating a rate buy down from sellers. Now, if you find a willing seller that's open to discounting their property, consider taking some of that discount and using it towards buying down the mortgage rate on your property. So let's assume you have a 2-year term. Well, buying that rate down maybe a full percent or 1.5% to get it from 5.75 down to 4.5, that might be about $18,000 to $20,000 in prepaid interest that you can actually have negotiated into the agreement that the seller will buy that rate down. And so that's a little nuanced negotiating tip that probably no one's done since the 80s, but that is very much legal and very much a great tactic to employ, because you don't live in the price of the home as much as you live in the payment. And so if we can get that payment under control, and then you can ride out this mortgage, this high interest rate environment for the next 18 months to 2 years, when it comes time to renew, no guarantees, but it's very likely that your mortgage rates will be well below what you can get today, and you got to enjoy that lower payment all the way through. And when it comes to price, we haven't found the bottom of the market yet, so be mindful of this. Do make sure that you price in a margin of safety. Now, one caveat to that, there are properties out there that you could pay full price for, that they priced it aggressively so it would move and it would be a great deal. There's your properties that were already priced 10% below market. We do see those. Now, there are properties that you could get a 10% discount on that are still not a great deal because they were 15 or 20% over market. So make sure you're getting good consultative advice from a realtor who can share with you whether or not you're buying something at market or below market. And I would implore you to try to buy anything right now a little bit below market, because I do think we're going to see a couple more price drops before we find the bottom. Now, as always, I will be the first person to report on when we hit the bottom. Just like I told you when we hit the peak in the spring, I'll tell you when we hit the trough. And I'm thinking that's going to happen probably somewhere to the tune of halfway through next year. And so we've got a little bit more pain to kind of muddle through. We got to see what this latest interest rate hike and the next one is going to do. We've got earnings reports coming out. We've got all kinds of things happening geopolitically. So there's going to be a little bit more pain, but it's always darkest before the dawn. And we know that markets are cyclical, and after every trough comes a corresponding recovery. If I'm looking at real estate investing in this market going into 2023, there are a few property types that I'm going to zero in on. The first of which is the duplex segment of the market. Now, a new rule has come out from the city of Kelowna that allows you to put legal suites in the basements of these duplexes and half duplexes. And so there's a really underserved affordable housing segment of the market where these sort of 2 up, 2 down or 3 up, 2 down half duplexes can now have legal suites in the basement. And these can be bought in that sort of $650,000 price point. And it's one of the only segments of the market where you can obtain positive cash flow. And that new rule has not been priced in. So I actually think there could be some price growth in that duplex segment of the market. The next segment of the market I'm really excited about right now is student housing. Now, for the reasons I mentioned in the video, there's going to be less inventory for student housing now that this new rule change has happened that's eliminated a lot of these short-term furnished rentals from going into the rental pool during the school season. So that means it's going to be even more competitive for students to find places to live during their school season. So I think house hacking homes that have many bedrooms that are situated near UBCO or near Okanagan College are going to be great investments going forward. Adding common utilities as well as Wi-Fi and things like that, you can get $1,000 a bedroom from some of these homes, and it's not as difficult to manage as one might think. So I think there's some real opportunity in the student housing sector. And thirdly, I think if someone has the staying power to buy a multifamily property or a commercial asset right now, the cap rates have gone way up because the interest rates have gone way up, which means investors are not willing to pay nearly as much because they can't make that spread between how much revenue the property brings in and how much they have to pay in interest. And so that's brought prices down in multifamily way more than any other segment because investors are just not chasing these deals like they were before. And so what that means is if you can buy it, break even, or even lose a little bit of money in the short term, once the market recovers, and it always does, you're going to pick up a massive upside when the market does return back to a 4 or 5 cap environment. Now that's probably Greek to most people, but if you want to chat with me about these strategies or any others, I'd be more than happy to sit down with you and consult you on the strategies I'm using right now to grow my portfolio. You can count on me to be your eyes and ears on this market. You can count on me to lead by example. I'm buying property every single day in markets that go up, markets that go down. It's like I say, there's no good or bad markets, only good or bad tactics. Now, if you'd like to chat further about buying, selling, or investing, you can start that process getting in touch with us from right here on the video blog. I hope you found this tremendously helpful. Thanks so much for watching, and we'll see you in a couple weeks.